investments in a low interest rate environment. Our speakers will be Professor and Dr. Peter Meier from the Zurich University of Applied Sciences and his assistant Regina Anhorn. You all remember Dr. Meier and Mrs. Anhorn from last year. Peter is the head of the Center of Alternative Investments and Risk Management. Before that, he worked at the Cantonal Bank of Zurich, where he was the chief economist and where he built up a modern asset management unit for institutional and private portfolios. He was, prior to that, CEO of Swiska Portfolio Management. He publishes regularly, he's on the board of pension plans, and again, he's going to be a terribly useful insight into the world of hedge funds and pension funds. Regina is a senior project manager. She's also a lecturer in financial investments, and prior to that, she served as a senior vice president and sell-side analyst at Lombard Odier. Let's give them a warm welcome. Thank you.
Thank you, Jerome, for the introduction. The providers of alternative investment sell or propagate alternative investments as the panacea in a low interest rate environment. The regulator wants alternative investment managers to offer more transparency, and some investors understand it as eliminating high-cost alternative investments. I want to explain why this cannot be a good strategy. First, from theory we know, and it's still true, if we want to achieve returns above the risk-free rate, however defined, we have to take additional risks. Active asset management does this, and the king's discipline in active management in terms of assets and in terms of different strategies are still hedge funds, then private equity, real estate, and other alternative investments. The risks these strategies face are market risk, like volatility risk, credit risk, but mainly illiquidity risk when it comes to most of the categories of alternative investments. Interest rates now have levels of 1 or 2%, and this is one of the main reasons why cost considerations have become so important. And if we go, but nobody does usually, to the purchasing power level, to the real returns, it's even less in some countries. Real rates of return are negative because inflation is higher. So no risk, no excess returns. This is still the starting point of reflecting about this issue. Switzerland is one of the attractive countries for asset managers because the asset base of pension plan is quite high, with 118% of GDP. The Netherlands are still higher, but if you look at this chart, you see that other countries like the UK or US, they are catching up in terms of this ratio, pension fund capital versus GDP. The next graph comes from Neue Zürcher Zeitung. It shows that interest rates have really reached their lowest point since 200 years. It might be a little bit less low now, since May. And what I find most interesting in this chart is looking at inflation, the blue line. There are 3 peaks. The first peak is after World War I, the next World War II, and the next the oil shock and the first real recession in the after-war period. What happens then is the debt accumulation. interest rates have been kept low after these peaks, and that's exactly the situation where we are in now. High government debt situation, very low interest rates, a wealth transfer from debtors to investors. And if you look as a chartist to this graph, you can assume that it's not necessarily that interest rates go up quickly, but that we can have a situation for several years where yields on bonds are very low, so that the wealth transfer goes further from debtors to investors, and that helps to solve the debt crisis. The next is just an example of a large Swiss pension plan, which shows that government bond yields are much lower than the required yields. Required means keeping the level of the funding ratio stable. And that's the problem of many pension plans, that their funding ratios is decreasing. The equity markets have helped a little bit for the last 12 months, or maybe a little bit more, but the future will show if in which direction it will go. What are the implications of this situation? Most of pension plans have reduced future distributions in their plans by reducing the technical interest rate or this discount rate. Some of the pension plans, but I think it's a minority, have increased risk to profit more from credit premiums, and other ones more think than do, invest into alternative investments. Other implications are that the ones which invest into alternative investments or hedge funds have changed their strategy. More go directly into single hedge funds. Some of the larger investors have built up in-house expertise. And that's a direction which is unavoidable, that large asset owners have to have expertise once they have decided to invest into alternatives, means investing into illiquid assets mainly. And if you do that, you must do operational due diligence to avoid that over the duration of your investment where you are stick in, that the quality of the asset manager does not deteriorate. Last year we did a survey and we found out that the cost awareness under pension plan managers is the most pronounced from the challenges they face or they perceive to face. And indeed, the total expense ratio discussion and transparency have taken a lot of time and a lot of attention. And I think there is a misconception in the system which is now applied and which is asked for by our federal pension fund supervision, because performance fee is also part of this total expense ratio, which leads to a situation where you have hedge fund or fund of hedge funds with high cost, high TERs for the last year because they had strong performance. I already come to the last slide before I hand over to Regina. Switzerland is a world leader in terms of low cost. This is shown by this chart, the red line, the lowest line. The United States is much higher at about 100 basis points. What are my conclusions from this? I think this is a problem for Switzerland or for the Swiss asset management industry. My perception is that the Swiss asset management industry is still in a crisis, and I measure it, for example, in percentage of value added, which stays in Switzerland with asset managers in Switzerland when we look at large investors. More than one of the very large plans, public pension plans, told me that the fee content of their portfolio, the fee content for Swiss asset managers is far below 10%. Where is the problem? Active portfolio management and all alternative categories are part of the very active portfolio management. Should not be too much emphasized by costs, but by good quality. Many academic studies showing in the same direction that the very successful hedge funds are the ones with the highest fee. And so cost awareness is always a right thing to have, but please not at the cost of the quality of active portfolio management. Thank you.
Okay, let me start with something encouraging, I hope, and also positive, because we have really spent quite some time not only analyzing recent surveys, but also analyzing pension fund reports, looking at their policy and talking to pension funds. And one thing which really strikes me as something very positive is, first of all, the amount of transparency from the side of pension fund is really extremely good. Only yesterday, for instance, I looked at the pension fund report of a major pension fund, where you not only have the report, but also newsletters and so on. So there's really an amazing amount of information flow also from their side. As you will see and hear as we go a bit further, there has been a lot of action, positive shifts to do the right thing. And also I think sometimes if you talk about alternative investments and pension funds, you have the feeling it has to do a lot with regulation only, frustration about missing performances, missing transparency and so on. That's not necessarily the case, at least not with those people we have been talking to, and they're encouraging shifts also. And I think this is also important looking into the future, to talk to each other on both sides, which means the provider has to listen to the pension fund. The pension fund wants a solution and tells him also what he doesn't like, and maybe also providers should in the future, if they haven't done that so far, listen a little bit more, and then I'm sure there will also be less frustration. As we thought it would be very helpful to look not only at the asset allocation of pension funds in Switzerland, but have a broader context. And therefore, I think what is really important is that Switzerland doesn't necessarily stick out very negatively if you look at hedge fund exposure, something like that. And that other countries, for instance, have a much bigger content in terms of bond issues or bond allocation, so there was much more need to reallocate in an environment of low interest rates. What you can see here is, again, what I already said, that hedge fund allocations are, on a European basis, fairly much in line with what we see in the Swiss pension fund industry. Contrary to what we have heard, and that to some extent, of course, on the other hand, also explains a little bit of frustration, the fund of fund principle, if you look at European surveys, has still been very much prominent, but of course, as we see more and more also larger teams being built up within the pension funds, with internal know-how, there might more switch into direct investments on the hedge fund side. The reason why we felt it's not satisfactory to talk only about surveys and the average shifts and so on is that if you look at the pension funds individually, you see fairly big gaps between one pension fund and the other. You know, you have those pension funds with a 5-6% allocation to alternative investments, but you have some of them who are fairly much more you know, allocated into the alternative investment side, be it hedge funds, be it private equity, commodities, or also infrastructure. And what I have added, just simply because this is so special, although I have to say this is of course not the typical pension fund framework, but still it's something one has to certainly watch very, very closely, is the CERN pension fund with a 30% allocation to alternative investments. And as you can see, we have added another example, which also doesn't, we have to admit, typically fit into the pension fund framework, but still these are very large international institutional investors, and they do have some success. And as you can see, ZHAW has a fairly large asset allocation part, and they can manage because, of course, as I said, that the regulatory framework is to some extent different, and also they have built up in-house teams. The important thing, I think, is that pension funds haven't been static at all. They have shifted. We don't see shifts happening in masses, but still the light blue indicates that they have decreased the bond allocation, specifically also government bond allocation. On the other hand, increasing the allocation to equity, and contrary to what we have heard from earlier discussion, there's no big shift from what I've heard into infrastructure or real estate, because at least those people we talk to have been fairly, let's say, realistic about what can be done with infrastructure and what the limits are in terms of in-house knowledge. What we see is, this chart explains a little bit the percentage share of pension funds which have reduced their allocation. So very clearly you see on the bottom fixed income investments have been reduced. 2002 and 2012 and 2013. On the other hand, this is a percentage of pension funds increasing their allocation, and there we see on the other hand stock exposure have been increased, and to some extent also real estate. If you have a closer look at alternative investments, we have spoken about the criteria already, so I directly go to some direct aspects. Theory, although you might say, well, this is theory, but still also clearly what has happened in the past, we have really seen if you have had a mixed allocation to equities, fixed income, hedge funds, where sometimes the allocation, the performance, but also standard deviation or volatility showed a bit better picture than if you didn't have a hedge fund over time, I admit. Also, if you look at this chart here, which looks at the drawdowns versus equity drawdowns, very clearly, as you can see from the blue color hedge fund index, equities looking not so brilliant in difficult times compared to the hedge fund side. If you go into the different alternative asset classes, and if you look at private equity to start with, amazingly enough, 1/3 of the Swiss pension funds hold private equity positions at this stage. However, not only hedge funds, but also private equity exposures are in some cases a reason for concern as far as costs are concerned. Commodities was a bit the darling of investors and also of pension funds. And as we have seen, there were some shifts a little bit out of commodities lately because of not too brilliant performances or some frustration. And amazingly enough, some people even talk about some revival in hedge funds, into hedge funds. So we'll see what will follow. An interesting asset class, some haven't developed it, some are already very much invested in it, is insurance-linked securities. The interesting thing is that if you look at the cake at the left-hand side for 2007, the reinsurers had a fairly strong position, and pension funds, if you look at the right-hand side in the investor breakdown 2012, have basically stepped in and are now fairly heavily invested there. So this is one answer of how to get still reasonable returns in terms of in low interest rate environment. If you talk to pension funds, they admit they had to invest quite a bit of building up their know-how, and so from that point of view, I think it's fair to say they have invested time building up the know-how and haven't moved there just blindly because it looked like a good marketing tool. The outlook and the conclusion, Ms. Yaki has already indicated what some frustration was on the insurance side. Is to some extent certainly also the same on the pension funds. Pension funds are not always very happy with the cost side. One pension fund told me he has never been indicated by providers that the 2 and 20 formula is not cut in stone, so maybe providers should maybe also be more prepared to negotiate, and pension funds on their side also be proactively be willing to negotiate. So there's action maybe from both sides actually needed. Then pension fund definitely mentioned as a possible stumbling point the complexity, which is a key challenge, specifically if you have a very small in-house team only. And on the other hand, again, with something positive, pension funds on average mentioned that diversification, liquidity, on that side, they have seen providers making progress, so there's certainly less complaints there. So from that point of view, if there's a bit more discussion on the cost side from both sides, the future perhaps is not so bad. Perhaps one little word to hedge funds. Maybe you look at the past as a possible indication for the future, and if you look at the last phases where we have seen upticks in interest rate development, then we have always had fairly interesting phases for hedge funds, and you can see this. We see that here happening 4 times in the past, and again, hopefully now. The conclusion really is alternative investment do, in our eyes, represent an interesting tool in a low interest rate environment, and some pension funds who so far have been a bit frustrated with commodities or others wouldn't exclude to shift asset classes if they get the right picture or the right story on the right product. And from that point of view, we also hope that there's not too much and only discussion on cost issues, because it only distracts from products which in some cases can really be interesting as well. And as Peter mentioned already, the 2 examples he showed from pension funds, there are quite a few pension funds out there who are already doing an extremely good job in terms of cost and transparency ratios. So from that point of view, it can be done and should be done. Okay, thank you.
Thank you very much for that, and very interesting insights into the pension funds world. which with Giselle's presentation I think gives us a very good view of what the Swiss allocators are thinking about. And now the moment you've all been waiting for, we're going to move on to the Bilanz and Hedge Analytics Awards, which will be presented by Oliver Liechti and Harry Busser. So Oliver was and is at the University of Zurich, where he is a researcher at the School of Management and Law in Winterthur. He was previously a portfolio manager at VZ, an independent wealth manager in Zurich, and prior to that he worked at GE Money Bank. Harry, I think many of you will know already, he's head of financial journalism at Bilanz. He's also a highly recognized moderator, a lecturer, and a reporter and producer for Swiss National TV. Let's welcome them. Thank you.
So hello everybody, we're trying to bring some glamour into this, and we did, as four speakers said, we did look for the needle, that bright guys in that industry, in the fund-of-fund industry, and also in the single hedge fund business. So we start with the fund-of-fund business, because the fund-of-fund business is the one that is much bigger here in Switzerland than the single fund business. I think that it's a pity, because we could have a lot of single hedge fund manager also here in Switzerland. And that's also why we got together. They're the specialists for the fund-of-fund business. I did, as the first journalist here in Switzerland, an analysis of the single hedge funds that are in Switzerland, where really the decisions are made in Switzerland, not only some service provider doing something here in Switzerland, but really the brains are here in Switzerland. And so we thought it's maybe a good opportunity to bring them both together, because as Switzerland is 1/3 of the European funding money for the hedge fund industry is coming out of Switzerland, but only a small part of it is also staying here in Switzerland. And maybe, I hope you met up some of the single hedge fund managers with the fund-of-fund business managers, not only the insurance people that are investors in both, hopefully, but also that you get to know each other a little bit better. So, without further ado, I hand over to the specialist for the fund-of-fund business, Oliver, please.
Thanks, Harry. So we're very glad to have this platform today, thanks to Roman Morger and Urs Durer. Bilanz HedgeGate Award, what is it? He already mentioned it. It's actually cooperation between Bilanz, the Swiss business magazine, the Zurich University of Applied Sciences in Winterthur, and HedgeGate, which is actually the platform that is managed by the university, which is a platform for fund of hedge funds. When it comes to the methodology, very quickly, it's what we did try to achieve is we wanted to have as a very objective methodology that is also replicable in terms of selecting nominations and then selecting a winner. So at the very beginning, there is a quantitative screening in order to find the 5 best funds within each category. And what we do is we put fund of hedge fund in different buckets. We do it with a style analysis, so we look which hedge fund style has been the most prominent contribution to the returns. So, and we use that in order to say this fund of hedge fund is multi-strat, this fund of hedge fund is non-directional, and so on and so forth. And then we have these buckets of fund of hedge fund, and in there we select the best 5 funds. These are the nominated funds, and the selection is done on one hand on an alpha estimation, on return, and on a conditional valid risk estimation. And of course there are other criteria like at least 100 million assets under management, and a company can only be nominated within one category. A company can only be nominated once. So for example, if a company XY has 2 non-directional funds in the top 5, only the better will be nominated. But a company can win different categories. So, and last but not least, there is a jury that decides which one of the 5 is the winner. And now I'm sure you're curious about the categories. It's 6 categories, 5 fund of hedge fund and 1 single manager categories. The first one is best diversified fund of hedge fund. It's actually the best multi-strategy fund of hedge fund. best equity hedged, containing long-short equity, emerging market. Best non-directional fund of hedge fund, more relative value, fixed income, arbitrage, event-driven. Then on the bottom in the middle, best trading-oriented fund of hedge fund. So fund of hedge fund where the major contribution to return came from global macro or managed futures. And best Swiss-registered fund of hedge fund. In here we have all styles, but the fund of fund has to be licensed by the FINMA, so it can be publicly distributed in Switzerland. And last but not least, the Swiss single hedge fund. It's a single manager product that's managed out from Switzerland, actually. So then we are already there. Just for organizational reason, we will go through the nomination, then name the winner, and then I kindly ask one person of this company to come to the stage, and then we have an award, a trophy, and then I kindly ask him to wait on the side because there will be a picture in the end. So the first category is best diversified fund of hedge fund. We have 5 nominated providers or funds. One is Legion Strategies from Skybridge Capital, OFI Palamares Alpha Drive from OFI Asset Management, Pictet Mosaic, Trading Capital Holdings, which is actually a cooperation between Banca del Ceresio and Banque Privée Edmond de Rothschild, and UBS Alpha Select Hedge Fund. So, and the winner in this category is Skybridge Capital. Hopefully there is a... Ah, so. Congratulations, Max. It's for you, and please on the side.
Please.
For the next category, we have a best trading-oriented fund of hedge fund. We have Areca Value Discovery, GHF SICAF Global Macro, Permal Macro Holdings, Pioneer Asset Master Fund, and UBS Alpha Trading. And again, I hope the company is present. The winner is GHF Global Macro Fund.
Someone here? Start trading is fast. Come on, run.
Didn't want to seem too keen. Thank you very much.
Thank you. Good. This is your award.
Thank you. We were here last year as well. So
yes, I know, yeah.
I hope to make a habit out of it.
Okay.
We hope so as well, because consistency is something that the industry needs, and we're hoping to see many of the nominees again.
The next category is equity hedged fund of hedge funds. So fund of hedge fund, long-short equity and emerging market is the main contribution. And in here we have Catch Capital, which Catch Capital ZHAW #1, Lighthouse Global Long-Short Fund, Lyrical Multi-Manager Fund, SPI Offshore, and UBS Global Alpha Strategies. And in here, the winner is Catch Capital. Congratulations. So, the second last fund of hedge fund award is non-directional. Here we have GAM MP Credit, GHF SICAF Fixed Income, Orbita Capital Return Strategies, PCAM Blue Chips, and Stable Growth Limited from UBS. And here again, the winner, surprise, it's again Thalia with the GAF SICAF Fixed Income.
Yes, nice.
Congratulations, really, it's a pleasure.
We're very pleased. Thank you.
So, and last but not least, from the fund of hedge fund side, there is the Swiss regulated universe, which unfortunately has shrunk a little bit during the last years. Here we have BSI Multi-Manager Yield Enhancement, again from Thalia, Edmond de Rothschild Pre-Fund Alpha Uncorrelated, HSBC Global Hedge Fund, IS Partners Diversified Fund, and Oyster Multi-Manager Low Volatility. And this category really on a on a risk-adjusted basis, we had to admit it's again Thalia. It's really strong performance in 3 categories, and I think that's worth an extra applause for your performance. Thanks a lot.
Okay, so now we go to the single funds, and the single funds, we straight go to the nominees, which is working like this. Next. And for one, we have Allegro Capital, a nominee that has profited lately strongly from the housing market, getting better in the US because they invest in housing market papers. Then we have GAM Investment Management with the Talentum guys that are in the southern Switzerland. And then we have Limot Capital Alternative Investments, they're from Zurich. And RBR Capital Investors, which is a long-short fund also based in the Zurich area. And we have Dominice & Co., which are in Geneva. And the winner is the Cassiopeia Fund. They have now a 10-year track record, and I think you have, what do you think? Do you think you can do this the next 10 years as well?
Absolutely.
Absolutely. How confident are you?
Well, you know, it's based on the behavioral finance problem we identified 10 years ago.
So you think people don't learn? They don't learn.
There is nothing as stable as human collective irrationality, in fact. So that's why we are very hopeful we can continue, and the company is extending. We are 17 working on that, so we are very confident for the future.
Okay, I wish you all the best, and I wish you a lot of consistency also in the future.
That's it from our side. Please visit Hatchgate
over
if
here,
you want
please.
further information on the Fund of Fund
For the
part.
photographer has better light over here, so that you look in this direction. 3, all the 3. Take all the 3. Okay, good. Can you go in the middle?
Get a bit closer, please. Fantastic. Really good. Okay. Harry, close, please. Super. Now look here, please. With a big smile. Fantastic. Wait a moment. Super. Great. Okay. Harry, a bit strong. Genau. Cool. Okay, now show me your awards, please. Hey, you're happy. You're the winners. You're the greatest. Fantastic. Cool. Super. Okay. Wait a second. Okay. Now one picture, just the winners, without Oliver and Harry. And get a bit closer.